carry forward is a really interesting one, and it's something that people don't always know about. They get confused about the way that you can do it, and it is really important, particularly in the years running up to a potential exit. So if you've got cash flow in particular years with a business, you've had a really good year, let's say, you think, corporation tax is going to be quite high. Utilizing carry forward as a business owner can actually be really useful. So what carry forward does is you've got the standard allowance of 60,000 in the current tax year. You have to use that first. But what it then allows you to do is go back and use unused pension allowance from the previous 3 tax years, starting with the oldest year first. Um, and then you fill that year, and then the year after that, and then finally the last tax year. So if you've had a really good year and profits are likely to be high, and you think I want to do something about this, what is one of the options? One of the options would be to utilize carry forward in order to maximize your pension and save corporation tax on the whole payment. It creates significant one-off planning opportunities. So it's good to have, in your kit bag as something to think about when you have a really good year. And also in pre-exit planning. So you can use it, I believe, as well for clearing things like directors' loan accounts as well, if there's a loan account in there. And for argument's sake, in the run up to selling a business, we do have business owners that will maximize the carry forward in the run up to selling the business. It gets money off the balance sheet. It can potentially help in terms of what that valuation might be, and therefore capital gains tax that would be paid on the ultimate valuation. Because if that money goes into that sale valuation, there's business asset disposal relief, and then there's capital gains tax to pay on that. But if you'd have done effective pension planning in the years before selling the business, you'd have got all that cash out of the business without paying any personal tax at that basis, at that point, sorry, then that could be something that's really useful to do. Now, something to remember as well. So, with regards to annual allowance, is that if you've accessed a pension flexibly, so if you take your tax-free cash, that's fine. But if you access any of the drawdown benefits of the other 75%, what you do is you activate something called the money purchase annual allowance. So you need to be really careful with this, particularly if you're a business owner. For argument's sake, let's say you've got a little pension scheme over here that you just think, oh, it's nothing. I'm not moving it into my work scheme with the company, but I'm going to take my tax-free cash and I'm going to take a lump sum out of that, 30 grand or whatever, and pay the tax on that for whatever reason that might be. Because you've gone over your tax-free cash, you've activated the money purchase annual allowance, which then means that you're capped at 10,000 a year to put back into a pension scheme. So you then can't do that effective planning through the company if you've activated that elsewhere. So be really, really careful, when you're drawing on pensions. Just to touch on the inheritance tax point again. So it is just a tax wrapper. So, you can call it a pension, you can call it an ISA, you can call it whatever you want, but effectively, a pension is a tax wrapper just like it is anything else. If you have pensions and ISAs with the same amount of money in them, or you put in the same amount of money in them, and they're invested in the same place with the same funds and the same charges, there would be a difference on the returns that you got because of the tax implications. You get a top up. If you're making a personal contribution into a pension, it grows tax-free, but then there's tax consequences on 75% of it when it comes out. With personal contributions to ISAs, you don't get any top-ups, it grows tax-free, and then there's no tax implications when the money comes out. So effectively, it is still a tool. It's still one to have, particularly for business owners in terms of, building up pension planning, and particularly in the run up to thinking about an exit.
I throw on a couple of comments on that.
Yeah.
Cool. So